thank you everyone for joining us this afternoon for the next in our series of webinars. So we acknowledge it's sort of not the most exciting topic today with assurance, but it's a very important one given the upcoming landscape and the upcoming mandatory Australian climate reporting. A little bit of housekeeping before we kick off. So you might have noticed everyone will have joined with microphones and cameras automatically turned off. That's as we're just sort of in this webinar setup at the moment, but you will notice there is a Q&A function. So if you have any questions as we do start to go through, then please do feel free to drop some questions in there, and we have some time at the end to run through those. So just before we kick off as well, just want to start in the usual way. So SLR acknowledges the traditional owners of the lands on which we meet today, which for me here is the Gadigal people of the Eora Nation. We pay our respects to ancestors and elders past and present. SLR is committed to honouring Australian Aboriginal and Torres Strait Islander people's unique cultural and spiritual relationships to the land, waters and seas, and their rich contribution to society. So a little bit of the agenda for today. So we'll start with this sort of welcome introduction to myself and Alison. We'll do a bit of a recap of the ASRS assurance requirements, the phasing and the introduction to those requirements over the years. From there, we'll jump into a bit of a background, Assurance 101, before moving on into sort of what you need to do, what it will actually look like, some tangible actions, and then what the review and audit process will look like for you. And finally, wrapping up with some Q&A. So just before that, it's great to see everyone in the room today. My name is Anthony Carr. I'm an associate within the Climate Change and Net Zero team with SLR, based out of Sydney, Australia. So currently, a lot of our work is around this Australian mandatory climate reporting across a whole spectrum of things, from diagnostic exercises to climate scenario analysis, decarbonisation and greenhouse gas accounting, and beyond. And I'm joined today by Alison. I'll let you jump in and introduce yourself.
Hello, everyone. My name is Alison Snellen. I'm a principal consultant in the climate change team and corporate sustainability. And typically, I'm based in Hong Kong, so a bit of a different geography, but this is a topic that used to be very familiar with me. I previously was an assurance provider giving assurance over greenhouse gas emissions, also TCFD disclosures when I was working in London.
Thanks, Alison. So that's a little bit of a background to who we are, and just very quickly before we kick off, let's give a quick background to SLR. So who are we? We're a global consultancy provider of sustainability solutions. So currently we're over 4,500 people worldwide, spread across 130 offices out of 28 countries, providing over 45 technical services from environmental engineering, scientific and advisory services. Within this region, obviously the topic of the day is Australian mandatory climate reporting. So within the APAC region, it jumped onwards a little bit, let me go back. We're 1,000 of those 4,500 people, offering that whole suite of technical services across 30 locations across multiple countries. So big presence across Australia, New Zealand, Indonesia, Singapore, China, and presence in Mongolia also. It doesn't want to change. There we go. So kicking off with a topic many of you might already be somewhat familiar with, which is the ASRS assurance requirements. So the intro to ASRS and the requirements to report under the Australian Sustainability Reporting Standards have a few thresholds that might be triggered to require that mandatory climate reporting. So there's a couple of different ways that an entity might get absorbed into mandatory climate reporting. One can be via the NGAS publications. So if you're an NGAS publication threshold or NGAS reporter at all, you may be required to report under ASRS from that perspective. Otherwise, there is a few triggers that may, based on your business size, revenue, require you to report under ASRS. So that would be assets, revenue, and employees. And you can see the thresholds there on the screen. But essentially, if you trigger any two of three of those thresholds, then that would place you in that group, and a requirement to report under ASRS, which has come in under the Corporations Act. So within ASRS, what does the assurance landscape look like? So regardless of what ASRS reporting group you're in and when it starts, you'll have a phased introduction to the ASRS reporting requirements. So whether you're group 1, 2, or 3, you will still have a 4-year sequence ramping up of what you'll have to disclose and the assurance required around those disclosures. So whether it's group 1 in sort of coming up very soon or in a couple of years' time for group 3, your year 1, 2, 3, 4 will still look the same. Within year 1, straight off the bat, you will be required to undertake and disclose limited assurance across your governance, your strategy, risks and opportunities, and also your scope 1 and 2 emissions. So that's within the 4 pillars of ASRS. So you've got that governance, strategy, risk management, metrics and targets pillars, but within those, they are split out separately and separate assurance requirements across those. From the first year, you'll also be required to report your climate scenario analysis, your resilience assessments, your transition plans, your approach to risk management, as well as your climate-related metrics and targets. However, for year 1, there is no assurance requirements for those. And additionally, it's optional to report scope 3 in your year 1. However, what you might see is from year 2, everything across the board, including that scope 3, will require limited assurance. And that is the same for year 3 also. So year 2 and 3, limited assurance across the board. And then for year 4, you'll be required to have reasonable assurance across the board. I'll note here, if you're researching this online or looking up this table and looking up this phasing, you may see something looking slightly different to this, sort of maybe not sort of quite so clean a trajectory, and that would be sort of an outdated phasing, and that would be reflective of the original draft standards for ASRS, which had limited and reasonable assurance coming in at slightly different times based on the topic. However, this sequencing here, this sort of cleaner phasing of from year 2, everything undertakes limited assurance, and from year 4, everything undertakes reasonable assurance, was confirmed in January as the approach that will be taken. So with that in mind, I'll now pass you all over to Alison for a little Assurance 101.
Thank you. Great. So starting off first, talking about the different stages of assurance, which Anthony referred to in the previous slide. So there are 3 different levels of assurance that your organization can move through. So here we talked previously, we talked about limited and reasonable assurance. So these are determined by the regulator based on the different years that Anthony described. Although some organizations may wish to move on to reasonable assurance if they, optionally decide that they want more robust data. Also, what is optional is this first phase here, which is pre-assurance. So pre-assurance is essentially optional for an organization if they're wanting to do a trial run, as we might say, with the assurance process. So it'll follow the same procedure as a typical assurance report would, although the assurance conclusion and opinion is only for the consumption of management rather than your assurance provider, publishing their assurance conclusion within the external report or your annual report or the sustainability disclosures. So the benefits of doing pre-assurance ahead of doing the required limited assurance or reasonable assurance means that your organization has an opportunity to get the data together, also to become more familiar with the assurance process, and essentially removes the risk of having a negative conclusion as it allows an organization to resolve issues before going ahead with the external assurance. So it's particularly good if within your reporting period you have quite tight timelines and you don't have much room for error if there are issues that flare up as the assurance process goes on. So in the past, I've had clients that have undergone this pre-assurance process before going ahead with external reporting. When I mentioned earlier that I was in London, where TCFD became mandatory for listed companies in 2021, and as TCFD became mandatory, some organisations started reporting, other metrics beyond perhaps the typical GHG emissions, and that's particularly where they found pre-assurance more useful and beneficial, where you have perhaps riskier metrics or perhaps riskier disclosures that an organisation is starting to make. If we go on to the next slide, then I'm sure some of you also who have been thinking about what the differences are between limited and reasonable, which I'll go into here. So essentially, limited and reasonable assurance are differing levels of assurance, with reasonable assurance being a more robust level of assurance. The main thing to be able to differentiate them is being able to see how the assurance conclusion, which you'll see in the kind of green line there, how that is phrased. So limited assurance is stated in the negative sense. So you can see here, based on the procedures performed, nothing came to our attention to indicate that XYZ is misstated. So that assurance conclusion is stated in the negative. Versus in the reasonable assurance, the assurance provider is going to be stating their conclusion in a positive sense. So based on the procedures performed, in our opinion, XYZ is reasonably stated. And therefore, it means that the assurance provider is going to need to have a higher level of confidence in their assessment in order to be able to provide this conclusion, which means that the procedures that they're going to need to perform for reasonable assurance are going to be more extensive than what you would be doing for a limited assurance engagement. The most like comparison is limited assurance is more similar to, say, a half-year review of the financial statements, whereas a reasonable assurance engagement is more similar to a year-end audit of the financial statements. And then thinking about what that means in terms of the procedures that your assurance provider will be doing. So for limited assurance, a lot of the procedures are predominantly going to be around management inquiries, having different interviews with the appropriate management about the disclosures, also doing analytical procedures. So looking, what are the year-on-year movements between some of the disclosures that you've made or some of the metrics. Whereas reasonable assurance, the types of procedures that will be above those of limited assurance are things such as test of detail. So asking for evidence and tying between the numbers that you have in your report and then, evidence that you have perhaps from third parties. You see the third party confirmations. Also perhaps starting to think about doing controls. So if you have review controls or other such controls that support the collection of your data, then also your assurance provider may be testing those controls to see how effective they are. Analytical procedures, that was something that I mentioned is typical in limited assurance, but also this may differ when you're doing the two different types of assurance. So limited assurance, perhaps just looking at a year-on-year movement, whereas reasonable assurance, they might be looking on how did your Q1 of last year compare to your Q1 of the current year. So those are some of those examples of how the reasonable and limited assurance will differ. So as Anthony mentioned, reasonable assurance becomes required in year 4. So the earliest that Australian reporters will be doing reasonable assurance is going to be 2028. So there's still quite some time there. And also compared to other markets, EU CSRD is also moving to reasonable assurance in 2028. So quite naturally, as that time approaches, there's probably going to be a lot more information in the market, and I expect that also the Australian standards would also release some, additional guidance in order to help prepare for that transition. If we can move to the next slide. Next, we wanted to discuss some of the kind of key terminology when we're talking about assurance. Sometimes it has its kind of own language that some might not be familiar with. And so these are 3 key ones that we wanted to discuss. So the first one is the subject matter. So the subject matter is the actual disclosures that your company, your organization is going to prepare, and this is what is going to be assured. So as Anthony discussed, you have varying requirements about what needs to be reported between year 1 and year 4. And in terms of the subject matter, it's going to be comprised of both the data. So for example, was mentioned the GHG emissions, scope 3 emissions, but it's also going to be narrative disclosures, like your governance or your risk management. And then also sometimes there'll be comparative information. And all of this information that's going to be reported is going to be housed within the sustainability report, which goes within the kind of suite of annual reporting. Then we have the criteria. So the criteria is the actual reporting standard that so this has come from the Australian Sustainability Reporting Standards, what you also might know as ASRS, and it comes within the Corporations Act, where it's stated what is the information that needs to be disclosed. And it lays out the information for talking about your climate-related risks and your opportunities. And then finally, we have the assurance standard. So this is the Australian Standard on Sustainability Assurance, or ASSA 5000. And this was released in early 2025 as a new standard. And this standard explains what are the expectations for assurance providers as they're delivering both limited and reasonable assurance engagements. And it's the equivalent, the Australian equivalent of the international standard, ISA 5000. If we move on to the next slide. Another key concept that we think is really important to kind of talk through when we go through this Assurance 101 is something that we call assertions. So essentially, these are key concepts that assurance providers are going to be keeping in mind as they're planning the procedures in order to assess the risk of material misstatements within the data that's being reported. So the first one is occurrence or existence. So are the activities or processes described actually in place? So for example, you have your governance disclosures. Are these structures actually in place in the organization? Perhaps your assurance provider might be asking you for minutes as an example in order to prove existence of these meetings and these committees being in place. The next one is completeness. So are all the events or conditions that should be present included with the information? So from a quantitative perspective, for example, greenhouse gas emissions, do you have all of the sites? Do you have all of the months in there? I've seen clients in the past where, the reporting is at the calendar year end and they forget to put in the final month because, the invoices come at a later date. That's an example. And also from a qualitative perspective, where you're talking about all of your climate risk and opportunities, are the full suite of risks and opportunities that are relevant to your organization, are they included within that? Then we have accuracy. So from a quantitative perspective, are you using the right emission factors? Do you have, the correct assumptions, perhaps where data isn't available? And then next for cutoff, this is thinking about is the information or the data recorded in the correct reporting period? So is the data from the previous December, as an example, accidentally included within the current year data? The next one is presentation. So are the disclosures appropriately aggregated or disaggregated and presented and described clearly? So from a quantitative perspective, for example, as you're summing all your GHG emissions, but then you're disaggregating in them the disclosure, scope 1, scope 2, scope 3, are they sitting in the correct bucket? And then also you'll be making some, qualitative statements describing what the reason is for the data moving year on year, and does that actually make sense, and is it consistent with the understanding that we've gained throughout the assurance process? Then we have consistency. So this is really about how your disclosures have been prepared year on year. So are you using the same assumptions, and do you have the same information, KPIs, scenario analysis? Has that been prepared also consistently? So these are some of the key assertions that will determine the types of procedures that your assurance provider will be planning. Next slide.
And that's back to me. So moving on from sort of that overview of assurance and those key terms and terminology, onto what do you need to do? What would it look like for you sort of on the ground and for your organization? So the first step to do is understand internal responsibilities that will come into play during your assurance process. So that's looking for the correct sort of resource allocations, personnel team, and ownership within the organization. So on that first point of owners, it won't be as clean as sort of with these ASRS requirements sitting purely with one team, especially with this assurance requirements, but it will sit with multiple people and really need buy-in from the whole organization. So an example of that will be the finance team. So as we've discussed already, this sustainability report will sit alongside the financial report and will undergo this assurance process. And your finance teams are very likely to be the most knowledgeable in this area and most experienced at undergoing these assurance processes and formal disclosures, especially under the Corporations Act. Moving on to from there, you have the subject matter experts. So that'll be your sustainability and environment team. So looking across greenhouse gas, your climate risks, your governance, and your handling of that. That will sit with your sustainability team, both in terms of sort of data ownership, but also in terms of making progress and demonstrable progress in those areas. So as you move year on year and you're looking to make progress on your greenhouse gas reduction commitments or mitigation and resilience measures against your climate risks, making progress in those will sit with your sustainability teams. And from there, there'll be internal stakeholders throughout. So you might hear us mention quite a few different teams and sort of internal resources as we go through, but that might be your finance teams, strategy teams, risk management, operational. It will vary depending on what type of business you are, but you'll really need that whole buy-in. So it'll sit with a few different places, but you'll need buy-in from a lot of teams and personnel internally. Moving on from there is the time consideration. So ASRS is a big change for organizations in considering these disclosures and undertaking assurance for a whole new suite of requirements. So undertaking climate reporting in addition to those standard financial reporting. So to be considered in that is both timescales and manpower required to do that. So obviously ASRS will impact a number of organizations that may be calendar year or financial year. So your reporting timelines may differ depending on that when you'll need to report, whether it be January, kickstarting in January or kickstarting in July. So when that does happen, there'll be a large amount of data gathering that needs to kickstart a lot earlier. So having those processes and systems in place so that you know you can gather that data in that short time frame to prepare and contribute to your report, but also considering your reporting timeline then between year end and when you need to report, making sure you have that time that you've got the data, it can undergo assurance, undertake any reviews and any corrections that need to be made following those assurances, and then be submitted to AASB. Finally, I've got here roles. So similarly to the owners, internal roles and governance structure should be defined. So that might be oversights, that might be your committee, your governance board, your executive board with oversight of your handling of climate risks and progress against those. But it's also sign-off responsibility, how your existing sustainability roles play a part in your ASRS disclosures, your reporting processes, and what both internally and with your assurance providers, what processes have undergone for that data review, quality assurance process, and data ownership. So moving on from that, the other thing I want to flag is your reporting vehicle. So what a lot of you might already have is what I've called here the public report. So you may already annually publish a report. It might go by a few different names depending on your organization. It might be your ESG report, sustainability, climate report. The public facing one that's very shiny and nice, has a lot of narratives in it, a lot of maybe potentially case studies, examples, and tells the story of your organization's sustainability journey. So separate to that will be this new disclosures report. The reason I've given it those two names for the purposes of this is that it's called the sustainability report. So it may have the same name, so you want to make sure you're aware of these two separate documents. So the sustainability report, which is called here the disclosures report, is what will sit alongside your financial report as part of these disclosures under the Corporations Act. So that will be much more compliance focused. It will consider the requirements of AASB S2 and how your organization is meeting those requirements and has met the mandatory reporting standards. So within that, you're going to want to consider the overlap between these two documents. So what information are you including in your ESG report that is within your mandatory reporting and therefore has overlap, so has to go to the assurance providers and may be open to change. So these two reports, this one you're presenting publicly and your mandatory reporting, should be aligned. So be aware that once you undergo assurance, your public-facing report should also reflect all of those changes. Within that, you should also consider fair disclosure and narratives that accompany any of that data. So whether it's around your climate risks, greenhouse gas, the narrative that accompanies that is also open to assurance, and it should be a fair narrative and representation of your disclosures. So you're not required within that to disclose commercially sensitive data. However, it should be available if audited. So that's particularly relevant around opportunities as well. So that data should be available and should be factual and ready for auditing by ASB. The final thing that I want to mention here is who can perform the assurance. So if you've looked at the prior standards, you may recall the initial ones said something along the lines of your financial auditor or assurance provider, which was then changed to a qualified. I would love to give a firm answer on this right now. However, based on sort of an update we got a couple of weeks ago, it's currently in consultation who has to be that assurance provider for you, whether it has to be the provider already performing your financial assurance or whether it can be someone else. So stay tuned. As soon as we have confirmation of that and as soon as that consultation has taken place, we'll look to share an update with everyone. But on that, I will pass you back over to Alison for an overview of the process.
Great. So before closing off, we wanted to give an idea of what can you expect as an organization who will have a sustainability assurance being undertaken. So when we think about the assurance process, typically we'll split it into 3 key phases. So the first one is the planning phase, then we have execution, and then conclusion. So what we've got here, we've got the key tasks, and these are from the perspective of your assurance provider. And then we have the output. So what can you expect as an output that you will actually see as an organization doing the assurance? And then the inputs, what do you need to be able to provide your assurance process in order to enable the process? So planning is very much about, kicking off the engagement, them understanding you, them designing the assurance strategy, determining their materiality thresholds. So your assurance provider will set a number of different materiality thresholds, both from a quantitative perspective and then also from a qualitative perspective. These thresholds, they won't actually be sharing with you because they'll be using these to be able to understand when they identify a misstatement, how material is it that they need to adjust their conclusion. The outputs are the materiality thresholds, which they'll allude to throughout your assurance engagement, but won't necessarily be telling you the specific numbers. And then from what you need to provide, you'll be needing to give, the subject matter information. You'll also be needing to give prior period data, and then also being able to hand over something that might be the equivalent of what you call a basis of reporting. So how have you prepared the information? Execution, this is kind of the meat of the assurance engagement. This is where all of the kind of testing and the procedures happen. So as I mentioned before, perhaps I won't go too much into this, but I talked earlier about the differences between the differences of procedures between limited assurance and reasonable assurance. And you can see here a listing of those types of procedures. And what we've done as well is put some kind of asterisk marks for the types of procedures that are more typical of reasonable assurance engagements. But in terms of outputs, typically your assurance provider is going to be coming to you with a query log, so a list of questions that come out of the procedures that they're performing for the assurance, which you'll need to be able to give your responses to. You'll have several iterations of it, most likely, and perhaps also evidence requests might be part of that. You'll also be expected to answer questions from the assurance provider, perhaps walk them through certain processes, and you'll need to be providing evidence to substantiate data and disclosures, particularly for reasonable assurance. And then finally, for the conclusion, this is kind of wrapping the engagement up, understanding the level of misstatements, summing those together, seeing if that means that they need to change their conclusion. And then they will be providing the assurance conclusion and report, as well as potentially a management report. And you will be providing your final kind of disclosure report or sustainability report, which Anthony mentioned, as well as written representations that you have prepared the disclosures and that there's nothing misstated, to your knowledge. So that's a whistle-stop tour of the assurance process that you can also refer back to at a later date. I'll pass back over to Anthony to close us off.
Yeah, thanks, Alison. this is the Q&A portion, but conscious we have just ticked over the half an hour now. We do have a couple of questions in the chat, so we'll be sure to follow up with you separately with answers to those. And similarly, if you do have any questions about any of the content we just covered, which hopefully was very helpful for everyone, then please do get in touch and let us know, and we'd be happy to help you out there. And we'll follow up with a recording to these slides. So if you need to pass it on to anyone within your organization, then please do, or respond if you would like any further information. But on that note, thank you everyone for joining us this afternoon, and hope you have a great rest of your day.